Welcome to Mining Over Canada. Join the Canadian Securities Exchange and our partners in a first-hand look into our country's vast mining landscape. Experience its regions, meet the people, explore the history, and find out what comes next in one of Canada's richest industries.
Welcome, everybody, to panel 2 of the Mining Over Canada finale. Now, this is going to be a great session because it's about valuation and gets into a little more of the bones of what it is to value a mining asset. And we're going to have a great session because my colleague, Mark Francis from Calgary, Alberta, will be your moderator today with a wonderful panel that he'll introduce. But I do want to mention a couple things as we get into today's session. This is part of the Mining Over Canada initiative hosted by CSC and Friends. You can see them at the bottom of the screen there. We produced over 60 videos of content, over 20 hours of knowledge transfer from the mining industry from across Canada, coast to coast to coast. You don't have to do it all in 1 week. We're going to have this thing up forever. So go into CSC TV, subscribe. We're going to have more sessions later this week going up, including these. But rest assured, after this video, there'll be more for you to dig into and sink your teeth into. So without further ado, we have a great session right now. Mark Francis, it's all yours.
Thank you very much, James, and welcome to Mining Over Canada. The worth of mining, how do the experts establish valuations? We're going to spend about a third of our time talking about early stage projects and then 2/3 talking about more advanced projects, typically ones with a resource estimate and in particular on preliminary economic assessments and pre-feasibility studies, aka PEAs and PFSs. We won't go into bankable feasibility studies as by then the valuations are typically being followed by analysts. Thank you to Anna Sarin, who has put together Mining Over Canada, and for arranging our panelists today. Kai Hoffmann of Soar Financial, Gwen Preston, Resource Maven, and Michael Gray, Agentis Capital. Delighted to have each of you with us. And why don't we start with having each of you tell your audience a little about yourselves and your mining industry experience. Kai, let's start with you.
Yeah, pleasure. Thanks for having me. Thanks for inviting me on the panel. I appreciate that. Kai Hoffmann, CEO of the Soar Financial Group. We're a diverse group of companies, 3 companies in total, Soar Financial Partners, more corporate communications, been doing that since 2010, 2011 already. Orin Inc., data company. We track financings in this space. We look at all TSX, TSXV, and CSC financings, but also Rohstoffbrief and TK News out of Germany, more on the publishing side. So we should be the super cheery cheerleaders for the industry, but we're realistic in our expectations of our clients and of the markets, and maybe not the typical promoter that you might come across, and maybe a bit of an outlier here on this panel because we have Gwen as a newsletter writer, Michael as more of an analyst. We should be always happy about all the results and everything coming out. I'm on the different side, so I'm more of the realistic person here. Not of the panel, but the realistic IR person. That's what I meant to say. And appreciate you joining us. And I think this is an interesting topic to discuss. And I think we got it well covered from all 3 sides. And look forward to the discussion.
Yeah, hi, I'm Gwen Preston. I write a series of newsletters under the Resource Maven banner. I've been writing about the mining space for longer than I want to admit, 15 years or so now. My background's chemistry and journalism, so technical background enough to understand things, ability to communicate is what I certainly try to do. And I write for a subscriber audience, so I just write about what I am doing with my own money, what I'm buying, selling, and thinking about in the metals and mining space. Certainly of late, the focus has been on gold and silver, but I'm open to anything that's mined, and I'm certainly interested in copper and uranium and zinc and all kinds of other opportunities. And I cover the whole spectrum in that I cover pre-discovery explorers all the way through to, Barrick Gold and major royalty companies, because I try and I try to provide investment guidance to a whole range of investors, and so they span that. They cover that span from high risk, high reward stuff all the way through to the other end. So I own them all, I buy and sell them all, and I write about my thoughts to those who are interested.
Yeah, thanks, Mark, for the invitation to be on the panel. My name is Michael Gray, a partner with Agentis Capital. A geologist by background with a master's. And my career has evolved from 10 years with senior mining companies, including Falconbridge, Cameco, co-founding a junior and running that for about 8 years. It's the Rubicon Minerals at the start. Left in 2005 and pivoted to the mining analyst world for the last 15 years. And so most recently with Macquarie, about a 9-year career there, covering explorer developers and all the way up through intermediate producers and a few seniors. So my approach has been to focus on the best of breed. I've got a research product with Agentis Capital, and look for those opportunities that I think are very compelling, and write about them and use my geological insights to look for value.
Excellent, Michael, Gwen, and Kai. So let's dive right in. Let's talk about valuations when there isn't an established resource, and in fact, even before a discovery intersection. So let's talk about how you try to estimate the value on a project which has not yet had a discovery intersection. And let's go Michael, Kai, and Gwen.
Okay, well, that's the challenging stage evaluation when it's often largely about people, and it could be a project where it's really driven by people that have a track record, and that might attract me on the outset. And to jump right into the valuation, I may attach goodwill immediately to that opportunity. In the context of what I'm going to be talking about today, I'm always using a sum of parts net asset value, and so various components adding up to that sum of parts NAV, so to speak. So goodwill would be one area, and I'll give you an example. If Andre Gamon, having sold Virginia Gold, started a new company, I did cover it, and I would attach about $10 million in goodwill right away. I would look at the land position and maybe attach a value per hectare, an enterprise value per hectare, and consider whether or not that location is right in the shadow of headframes, which I'd give a premium land valuation to, or if it's really moose pasture and it was really the cost to stake the claims and maybe some other value. And finally, if there's a transaction, there was an appraised value, I'd use that.
I'd say this is this conversation will probably lay quite bare the differences in approach to valuation. And so Michael, obviously as an analyst, his name describes exactly what he does. He's very computational in how he comes up with these numbers. And I think Kai as well, we'll see, work a little bit more on a not so much of a spreadsheet basis and more based on the similar considerations in inputs into the number, but perhaps not as much on like a per hectare type value. What it comes down to is if I'm trying to assess the value of a new junior explorer who hasn't got a discovery yet, they're coming out of the woodwork right now. They're everywhere. And the valuations when they come to me, perhaps trying to raise money for their IPO financing, I mean, they literally range from 2 million to 40 million for companies that on the very surface might look comparable, right? Maybe 1 or 2 projects, no discovery intercepts, an idea of why there might be value there. And so how do you decide which one's good value? There are so many factors that go into that determine how it will be carried in the market. And certainly so the location of the project, the people who are involved. The people, it's not just do they have a track record of success. It's, how much capital markets experience do they have? Will they develop a supportive shareholder base who will help carry the share price through come what may? What is the share structure? Is a lot of it tightly held? Is there a warrant overhang? Is that going to play a role? Is there a free trading date that's going to hammer things if there's excitement in the first 4 months of trading? That capital market side, very important. And then really another important capture that I look for is not just what is their geologic model in theory, but can they explain it? So there's a lot of geologists out there who may well have an idea about why this Red Lake or Kirkland Lake, whatever project has potential. But when you go to their corporate presentation, it is not clear. I do not understand what they're doing, why they're doing it, what their plan is to create value for shareholders tomorrow, next month, next year. this is a business. I love science, but I don't invest money for people to go and do science experiments on rocks. I invest money because they think that their science experiment, they have clear reason to believe that their science experiments are going to create value for shareholders. So I really need to see that captured. And I think if that is clear and apparent, that's a good indication that the business model and all of the other, a bunch of the other parts that really influence how the market will carry a stock are in place. I realize that's not a super clear-cut answer, but that's the approach that I take to these early companies.
And I don't think there is a clear-cut answer, because there's so many soft factors going into this. And when we look at it as well, and maybe coming more from the corporate communication side, and Gwen touched on a lot of it, and Michael, of course, as well. But like soft factors, like how good is the management team? Is it, and don't take that the wrong way, I'm not sure exactly who's listening. Is it a 70-year-old geologist who's been running the company for 30 years? Then maybe 40 million market cap for the same thing might be too expensive, right? So like I'm looking for upside, like even for anything that I can present to my investors, like where is the upside? At a 40 million market cap, and Gwen said, like, let's say there's a company with 5 million market cap, but one there's with 40. So where's the value creation upside? There's a reason why one is at $5 million valuation while the other one is at $40 million valuation. And oftentimes that's management. And as Michael said, there's a lot of goodwill priced in with good management teams, and you have to pay extra to get the top teams. That's just what it is. You'll never get the seed financing at 5 cents. That won't happen. But you might get a chance to participate at 50 cents in a stock that might go to $2 or $5. Right. So that's the upside. But also, like we look at a thing is like at Soar Financial, we try to see things through to the end. So even if it's pre-discovery, and we're not geologists, but we do have a good network, we try to find something that makes sense in the long run, right? Of course, if the drills don't hit, that's a different story. Geology is that's a nature, like it giveth and taketh away, right? And but like, does it have a chance to succeed? And it comes down to like, what area is it in? Is their neighbor successful? We don't necessarily like area plays unless something goes straight, like the trend continues straight and you can see it light up in early stage, like geophysics, mapping, and all that. That's very like, and what's the end? Like, what's the end game? Maybe $5 million, you get the steal of a century. You might find something, but we're all buying lottery tickets at this stage. All you can do is cross out a certain number of numbers to increase your odds. And I think, in summary, what Michael and Gwen said is perfect. You got to find your own lottery ticket, pretty much. You got to cross off the numbers that you feel comfortable with crossing off, and increase your odds that way, I think.
Very good. Thank you. So now let's say there's an initial discovery. So what do you think is important? Because sometimes even just a sniff of gold or a hit of volcanogenic massive sulfide can indicate they're on the periphery of something larger. But there's also the counter argument that companies tend to drill the very best part of a geophysical anomaly first. So let's take us through that, and let's reverse order this time and go Kai, Gwen, Michael.
Well, first, I think you got to define what a discovery is. It's not just a press release put out by a company, right? So you actually do have to have a discovery, and it needs to be verified by third parties, in my opinion. And it's not just the company putting something out. Of course, a nice intercept of 10 meters at 10 grams is fantastic, but is it the definition of a true discovery is the first thing you need to answer, right? But then again, it's like it comes down to the philosophy, like in the long run, will this actually work? So if the discovery is made, like what's the size of the project? Is there even room? Let's think about a production scenario. Do you have enough size, land package? Do you have the extensions? Do you have everything covered? There are so many aspects, again, going into this, but a discovery, what's the continuum? Michael should have answered first. Actually, he's the geologist, right? Like how do you look at this from a geological perspective? Of course, as the IR guy, I try to be as positive as possible, but being realistic. Right. So where is this going? Where is that intersection? Is it at the far end of the project? Do we need additional ground that's owned by a neighbor? Is it where is it? Is it on a steep dipping hill? Will you ever be able to build a mine there? There are so many factors that go in there, and I really want to see a follow-up program, and not just one whole wonder to promote the share price and maybe raise some more money at a higher valuation. And I think in investors, we've seen that in the last 12 months actually quite often, that companies have drilled vertical holes straight down a chute. Just to come out with a nice flashy hole. I I don't like seeing that. That's not a discovery. That's cheating the market because you're extending the length of your discovery hole unnecessarily. Not everybody sees that. So yeah, that's the type of discovery makes a difference.
I think valuation on a discovery hole is almost impossible because there's not enough information. So there's a geologic theory. That's why they drilled where they drilled. And then there's now some data to put into that theory. And so you can start to, it's basically the first input as to whether that theory might pan out. So then there's a few ways to go from there. First of all, what is the size of the prize based on the theory? Is it a really large prize? Is it quite a small prize? Is it high grade? Is it low grade? So just keep in mind, in general, what's the size of the prize? Bigger is better. But so, yeah, what are we even looking for? And if we're talking about a discovery, then it sounds like we're talking about a situation where this initial hole suggests, okay, so far the theory is playing out. Okay, so what's the size of the prize? Maybe we've just taken a step in that direction. That's important. But I think almost more important, or just as important, if you're an investor who owns a company and they hit a discovery hole, assuming that we're in a reasonable day of the market, and so there's some sort of reaction to that news, that's what I would call appropriate, often the market will go a bit crazy. And does valuation often overshoot because of excitement on a discovery hole? Yeah, a lot of the time it does, especially if you're talking about a high grade discovery hole or even a very long discovery hole of good grade. There's a lot of situations where where investors get excited, and you can't blame them. That's why we're in this game, because we get so excited about discoveries. And so they get excited and the value often overshoots based on what is appropriate at that moment. And what is appropriate to sort of see over the following month or months come out of that project. Now, why that's actually useful is that if you are an investor and you get to ride up that excitement, perhaps overvaluation run, then sell some stock, get your cost base down, and then keep enjoying the ride. Don't try and guess on a discovery hole whether this thing's going to become a mine. Because first of all, you don't know. And secondly, that's a decade out anyways, and you're probably not going to own this stock for a decade. So don't worry about that. Worry about, is this an opportunity for you to reduce risk? Exploration is an incredibly risky business. And so if you're given the opportunity to reduce your risk by selling some stock into a share price spike, you should do that. If you really like the stock, then absolutely keep a bunch of it, but sell some into the gain. Then there's the follow on, where if it's a really exciting discovery hole, there's this irony where the market suddenly gets its expectations really high, and it's tough for follow-up holes to meet that super high bar. So the irony is that a very exciting discovery hole can almost hurt the company valuation going forward, because I would say Vizsla is perhaps a good example right now. Their first few holes that they hit down at Panuco, there was 7 kilos of silver in some of those holes. They haven't managed to hit another 7 kilo of silver hole. And so the market has been somewhat disappointed in their results, even though their results are doing a good job of fleshing out high-grade shoots at this vein project, which is exactly what they need to be doing. That's fleshing out the geologic theory. So I think there's a bit of if it's a really exciting hole, that should encourage you even more to take some money off of the table. Understanding valuation on an initial hole is based on the size of the prize, but you have to be very pragmatic about the other pressures that will influence the share price from that discovery hole over the next 6 months to a year, which involve financings and warrants and expectations on follow-up holes and marketing programs. It's not simple. Share prices do not just move based on geology. So just be aware that valuation ebbs and flows a lot in those first months based on a lot of different factors. So I just say use opportunity to reduce your risk.
Yeah, I think that Gwen's done a really good job to frame the size of the prize. And that's certainly my approach on an initial drill hole discovery. What's the geological setting? Is it tier 1 geology? You have the potential to be tier 1 size in the gold sector, at least. That would be something that would attract the seniors, 300,000 ounces a year or above production potential. And so it's the pedigree of that geology. And I'll give you an example. When Gold Standard Ventures drilled 42 meters of about 9 grams back in about 2012 on the Carlin Trend, that was something that resonated with investors. They understood the track record, and the seniors, the track record of that geology in the Carlin Trend, and the anatomy of those deposits, the depth of those deposits, and it created a lot of excitement and focus on that company. I think when Mag Silver first drilled their first hole and Fresnillo immediately joint ventured that project back before 2010, late, I think it was 2006 or so, in that Fresnillo district with its history and track record, best of breed type of geology and deposits and margins. That's something right away, knowing you could be into a new system, new vein field in that case, could be very, very important. So it's a matter of filtering, for me at least, some of the geology. Is it best of breed tier 1 or not? And that's an important moment for me to jump onto a new story.
Very good. Well, and Michael, let's carry on with you and stick with the theme. We've made it. There's a discovery, and Gwen has talked about several more drill holes going into the discovery. How does that start to change your thinking, and does it start to change the goodwill you might ascribe to a management team? Does the one start to displace the other in terms of valuation? Yeah.
No, it doesn't really change the goodwill. At that point, it might have been at the outset I'd assigned it if I was attracted to that company. But yeah, once you've got a drill hole and you know the context of the model, what you might expect, you really focus on continuity. And to me, at the early stages, depending on the model, especially if it's a nuggety gold system where you're going to hit and miss on grade potentially with a small drill hole, I'm looking for thickness. I'm much more interested in the system being robust. And I'll use Richmont as an example with their Island gold project, which I covered in the past. If drilling step-out drill holes down 200 meters below any documented resources, and they're starting to get twice the thickness and twice the grade, if they continue getting twice the thickness of what they're mining, I would still be very encouraged. I'm not going to be discouraged should they have a lower grade hit in a nuggety system, as long as they're proving continuity of the system. So that's an example of what I would look for immediately, depending on the geological model and how predictive it is. Are they continuing to have a high hit ratio, or what you would expect to have?
Yeah, I think Michael's captured it for sure. It all is about how do the subsequent holes continue to flesh out, support or deny the geologic theory, and or change it. I mean, rocks are down there and we don't always know what's in them. And so certainly if it's not supporting the theory that they went in with, then the geologists often can come up with a new theory. And so again, it sort of harkens back to my first answer there. It's about what the results are, what size of prize is it outlining, what sort of scale and continuity are we seeing in those initial holes, and then how clearly is the company communicating what they're doing, why they're doing it, what you should expect, what the next step is. This is painting the picture, because if it's a nuggety system and therefore misses are going to happen, then the company needs to put some effort into explaining the kind of system that they're testing. If you're testing for multiple porphyry centers and you hit one, and you're also doing a regional program where you're testing other centers, you need to be very clear that, hole 57 that you just released is not actually in this porphyry, it was on another target. It's pretty complicated stuff. I do not, I'm glad that I don't have to be the one trying to convey all of this stuff all the time, because it can be confusing, but it's really important for the company to communicate what they're doing, why they're doing it, be very consistent in their information, and that just helps create reasonable expectations, helps the market understand what could be coming down the pipe, what represents success versus failure on a discover or on a drill hole, and that should help ease those crazy share price gyrations that you can get if the market isn't as prepared for the range of results that just are what happens with a new discovery.
Exactly. Like, and I don't have too much to add, but in terms of management goodwill, and touching on what Gwen mentioned as well, depending on how you communicate the story and how you communicate the misses and the hits, makes up a lot of goodwill as well. Right? The good management team stands in front of you and actually says, okay, we missed here. We tried a theory, didn't work out. We stepped out to the west. It wasn't there. We thought it'd be under a fault. Wasn't there. Okay, next theory. Let's test it. Let's drill to kill it. And that builds a goodwill. I don't have anything else to add in terms of like size, grade, continuity. That'll come later on. That'll come with more holds. But communicating that story. I can't put the gold in the ground. I'm not an alchemist, right? Or the copper or whatever it is. But we can see that the management team stands true by what it said. It's been following its guidelines, and whether it's confirming what you've been looking for anyway. So that's all I can add to that question, actually.
Well, that's good. And now I'm going to look for some very short answers, because it's not a simple question, and I'm going to look for short answers. You've got a company which has many drill holes into it. It's well past discovery, and they are not spending the money to demonstrate to calculate a resource. Does that worry you? And let's start with Kai, and then Gwen and Michael.
Not an easy question, but no. But again, it depends on the management team. Who is it? All right. There's a reason. Is it a brownfield site that 10 juniors ran over before and drilled a bunch of holes in? Who drilled those holes? If the management team drilled the holes, there's might be a reason. Some reasons are that you don't want to put a valuation out because you haven't hit the target internally that you've been looking for, and you might need another season. Why aren't you at that stage? Has it been seasonality where you snowed in, you couldn't finish your program? So again, mining is not yes and no. It's not black and white. There's so many answers. That's why it makes our jobs very, very difficult valuing something. Like, I'm going to ask, maybe forward that question to Michael. How do you put a valuation on being snowed in and having to delay your program? Like, how does that affect your NAV, right? When you come to a calculation like that. So, short question, no, pending certain facts.
It can absolutely be either way. I've been communicating with a subscriber recently about a company that they're interested in. And when I look through the information, I don't understand why they haven't calculated a resource. And the only thing I can come back to is that it hasn't really been working that well. And so even though they've put 4 years into the project, they don't really have enough of a resource. So that's an example where, you know, the lack of a resource is a serious red flag. And it goes back to that whole fundamental thing about what are they doing to create value for shareholders? And if it's not working, then a management team needs to move on to another project. It's not an easy decision, but it's necessary. So that's an example where it certainly does matter. Great Bear is an example on the opposite end of the spectrum. They have hundreds of holes into their project now, and there's a very good reason why they haven't calculated a resource yet. It's because they're still figuring out how big the initial part of the deposit is that they're trying to capture. And they've been very clear in communicating what they're doing, why they're doing it, when they will calculate a resource. So that's the opposite end of the spectrum. So it absolutely depends on the company's approach, success, and explanation for why there is or is not a resource.
Yeah, it's I think both Kai and Gwen have answered it very well. It can work both ways. My example would be Andre Gaumont, Virginia Gold, when he discovered the Roberta zones at Eleanor. He was doing 100-meter step outs. He didn't need to do a resource. It was growing every time he drilled it. And as an analyst, I had this advantage of being able to make my own estimate and value it accordingly. So on an EV per ounce basis, I took the data, I plotted the sections, estimated about 3.6 million ounces. And then I had optionality, but probably because of the model, maybe doubling the size potentially to depth, because I thought it was a Hemlo model. So in that case, I had no problem with there being no resource, and it was a competitive advantage. But to the point that Kai and Gwen have made, there's lots of companies that just kick the can down the road because they probably can't meet market expectations.
Right, and part of the reason might be because the rocks pinch and swell, grades can come and go, and they know that a resource estimate could be when the discipline is applied, might be weak. So let's hear from Gwen first on this one. And in particular, let's just have Gwen answer the very first question, and then we'll go to everyone on the next question. We hear about net present value calculations in PEAs and PFSs. So could you give the audience a brief description of what's going on there? What does it mean?
Sure. So you'd make a discovery, you define a resource, perhaps you grow that resource. At some point, you have to try and wrap your arms around whether it makes sense to mine that resource. And that's a PEA, a preliminary economic assessment. You do an initial mine plan. The data required for a PEA is quite limited compared to the more advanced studies, the pre-feasibility and the feasibility studies. Once you get to a feasibility study, that's literally the blueprint for how you will build the mine. So it's incredibly detailed. PEA is the starting point. It's not detailed. Really, when you get to a PEA, when a company publishes a PEA, there's a net present value. So what is the thing worth today based on a discount rate that you apply because of the uncertainty, based on assumptions for metal prices, and based on a whole range of other assumptions like how much is it going to cost to mine each ton? What are the recoveries going to be? There's been initial metallurgy done, but not detailed metallurgy. So a lot of assumptions that have to go into a PEA. That's just the nature of a preliminary mine plan. And so the numbers matter because they capture how this mine would look, open pit, underground. If it's underground, what kind of underground? Like sort of what scale do they think this operation could be? What would it just sort of look like? So they matter for sure. But if what I always do first is see who did the PEA. And I don't mean which company, like the company, because I know which company put it out, but like which consultants worked on this PEA, because there are so many assumptions that go into a PEA that it really matters what those assumptions are. The same inputs and then different assumptions can create very different outcomes for a PEA. And so that's why PEAs are sometimes called dream sheets, because if you use very optimistic assumptions, guess what? The numbers come out looking great, but that doesn't really matter, or that doesn't really carry any weight. And so while a very shiny PEA with strong numbers might impress the market initially, as a project advances down that trajectory, PEA, PFS, feasibility, what matters more and more are what the institutions and the major mining companies think of the asset and the mine plan. And if you're spit shining your assumptions, then they're not going to be impressed. And so a robust and conservative approach out the gate is what I want, even if the numbers that it spits out maybe aren't the shiniest. They create more options for endpoints, because with any stock, what are our options? Getting bought out or building the mine. Whichever of those you follow, you darn well better have a realistic mine plan that you're following. It increases the odds that you could get that bought out, because the majors aren't going to pay attention if you're not using conservative, good, reasonable data and assumptions. And it creates a mine plan that's actually going to work when you build the mine, if that's the route that you go. So, sorry, that was a bit of a circuitous answer, but that's my look at PEAs.
Very good. And we're reaching close to the timeline. So I'm now going to ask Michael and Kai, what do you look for when there's a PEA or a PFS, and what are the risk points, and how much do you weight the net present value calculation? And I'm afraid I have to limit you to about 60 to 90 seconds each at this point. So Michael and Kai?
Yeah, I'll try to be brief. At that stage, looking at the discounted cash flows, I'll look at, really, do they have critical mass in terms of the resource they put into the economic study, in terms of mine life and making it worthwhile. I'll look at the resource model, how much of it's inferred. Inferred can be fairly loose in terms of conversion. What would the conversion rate to be to actually move it forward? How real is the project in that sense? And is there a lot of upside that's not in the PEA in terms of resource potential, in terms of low-hanging fruit that could be added should they take another step? So that's really key. And then I would really look at the metallurgy as well. That can sometimes hurt projects at a fairly early stage if that wasn't well looked at. So I'll hand it to Kai.
Yeah, you stole my metallurgy point. So, because I just looked at a PEA the other day where they mixed in sulfides and tried heap leaching sulfides. And that makes me nervous because the recovery of sulfides on a heap leach pad is fairly low. It's around 30% if you're lucky. So, but to keep it short, things I look at, IRR, obviously anything above 20%, foreign's a closer look, but also gold price and price assumptions that went into that. Some companies are super optimistic and put up base case PEAs with 1550 or higher. That makes me a little nervous because why? And why not use 1350 just to show you have a very, very solid project at that level? Also, gold, silver equivalent, gold equivalent ratios, NPV discount. If you're in a, let's say Peru, for example, why use 5%? I'd never apply a 5% discount to that. And then you can dive down deeper. And Michael mentioned metallurgy, of course, but trucking cost is an interesting one. Where do you need to put things? Like that's one that maybe stands out easily that you can play with depending on where the project is, and then you can dive deeper. But I think the first four ones, I think the most important ones to filter through the first part. If you're still convinced it's a good PA, then you can dive deeper and look at more numbers that they give you. Usually 45 days after they put out the PEA press release, you might be able to find the technical document there on CDAR. Take a closer look at that, read that at your leisure. But there's usually good information also on infrastructure and other things, and see if their assumptions are realistic. If they need to build a 100-kilometer power line, does a cost of $5 million make sense, for example? I don't know, just throwing out numbers, but that's something you can check.
Excellent points. And now I'm going to look to each of you, Kai and Michael and Gwen, for a closing word of wisdom for our listeners.
A closing word of wisdom. I think it's not binary, right? Mining is not binary. It's not zeros and ones. It's not black and white. I think we all mentioned so many different points to look at. Look at points that are most important to you, whether it's ESG, is it the management, is it the project itself, the location. That's like if you're playing the discovery place, you could pretty much buy almost every junior that's about to drill in 2021 and trading at a 5 to 10 million market cap. Put $1,000 in each, and I'm sure you'll hit something, right? But you can zero in. Like we tried to give you some pointers during this during this panel to hone in and increase your odds, and maybe going from a 1 in 143 million chance down to maybe a 1 in 5 million chance to hit something, right? And playing lotto. So try that and just get you as much information as you can. You're playing with your own money, right? So if you're just punting, go for it. Can't stop you, but try to be as educated as possible. And that's one of the missions we have at Soar Financial as well, is try to educate investors. That's maybe one of the mission statements.
That's good. We're in crunch time here. Michael and Gwen, sorry to be abrupt.
Yeah, I'll be fairly brief. To me, it's really geological risk and whether the opportunity has the right attributes to actually be world-class is optimal, but otherwise something that's very, very attractive, best of breed, and most of these juniors sell their projects. So you need it to have a lens on the project of an intermediate or senior producer. You want it to be bought. So I also look for those attributes so that they do have an exit.
There's so many factors that move junior company share prices. So my comments are, if you want to play the discovery end, you got to own a lot of stocks because the risk is there. Make sure that the discovery stories are clearly communicated, because that's a good look at whether the management team is clearly driven in what they're doing. So communication is a good representation of that. I would say once you get to the more advanced end of things, actually anywhere along the spectrum, don't try and do it by yourself. One of the things that I love about our industry is that there's geologists, there's engineers, there's CFAs, there's communications people, and we all have to work with each other. There's capital markets people. When we all come into the space, we all know our thing, and we need to learn as much as we can about everybody else's thing. And after 15 years, I still have a whole list of people that I send questions to about metallurgy, engineering, geology, capital markets things. I ask questions all the time because it's a really complicated space. So don't pretend that don't think that you should understand any particular stock or any particular plan or trajectory. Ask questions, find sort of a team of people, like-minded investors or newsletter writers or analysts who you're friends with or online forums, whatever it might be, and ask questions and then manage your risk. Don't fall in love with a story. manage your risk. If you're given the opportunity, don't fall in love, get out if it's not working. This is a risky space, and when they win, they're super exciting, but the odds of a win are not that high. So just be aware of that.
Thank you. Thank you, Gwen. Thank you, Michael. Thank you, Kai. Thank you to all of our panelists. I really wish we had more time to spend with them. I've been learning a lot, and we could dive for another 2 hours. So thank you, Kai Hoffmann, Soar Financial, Gwen Preston, Resource Maven, and Michael Gray, Agentis Capital. Thank you also to our attendees. Note that the final panel session, The Mining of Tomorrow, What is the Future of Mining in Canada and Beyond, chaired by my colleague Barrington Miller, will start at 3 p.m. Eastern. And of course, you can see all of the content for Mining Over Canada on the CSC YouTube channel. Thank you very much, all.